Welcome to the Alternative Finance and Yield session. As a pretty interesting backdrop to this, Tradewinds only last week published an article based on some Petrofin analysis showing that as at year-end 2017, the total shipping loan from shipping banks outstanding was $345 billion US. And that was after the top 40 shipping banks had reduced their exposure in the loan market by $42.5 billion in 2016 and another $10 billion in 2017. They also pointed out that the total ship finance amounts from shipping banks had fallen by 25% since 2008. And during the same period, the fleet growth has been a bit more than 28%. And we now hear from, I think, a very interesting banking session that the banks are likely to retreat still. They're concerned about regulators, whether it's capital adequacy requirements or environmental issues. They have a flight to quality. They will serve the biggest customers and be less available to the smaller customers. They fight for capital internally, and they require more equity. So there can be no doubt that there is a requirement that there is a source of finance other than bank finance going forward. And luckily, it is there. We're not going to discuss all sorts of alternatives, but some of them, and we have a very capable and innovative panel here, the names of whom you can all see. They come from different companies, all of which may not be quite household names. So I would suggest that maybe each of you give a brief presentation of where you come from, and maybe George, if you could start at your end.
Thank you very much. So I come from YieldStreet, Marine Finance. It is an online alternative asset-backed platform. Just very helicopter view. We have a balance sheet of 100 million. We fund, in other words, we underwrite the deal. We then package the deal and sell it online. Who do we sell it to? We have 65,000 subscribers, growing at 5,000 a month in the US. These are accredited investors as defined by the SEC. These are people with over $200,000 a year in earnings or $1 million net worth. The platform allows them to sign on within minutes, and technology allows them to put their money into the investment and for us to pay their coupon and to generate the tax forms and anything else they need, all done electronically. So the rest of us can go out and source deals. The way we source deals is through originators, and we have a global network of originators. We're going to build out for shipping. Right now, we have a litigation finance. We have a real estate bridge financing, vendor financing, and as of May, we started marine finance, of which we'll speak more about during the session.
So in a sense, it's a sophisticated kind of crowd financing, this one.
Yeah, it's allowing people that haven't been able to get a decent return on their money access to decent returns.
That's a pretty new and very interesting feature. Richard, on the RMK Maritime.
Sure, yeah. So I'm Richard Moore. I'm Managing Director of RMK Maritime. We're a London and New York-based financial company, and we operate right through the capital structure. So an example, at one end, we were the sole M&A advisors to Euronav on their purchase of Generate. We get involved in various forms of capital raising, but also quite extensively involved in lease arranging. We've done approximately $500 million in the last 12 months or so for public companies and oil majors. And we've recently raised capital in order to write first lien loans from an RMK platform. So we are direct lending at the moment.
Eirik, Ocean Yield.
Yeah, my name is Eirik Eide. I'm the CFO in Ocean Yield. We are a stock-listed company. We provide maritime leasing solutions for our clients through that we do 12 to 15-year bareboat charters with either purchase options or purchase obligations at the end. We started the company back in 2012. Then we had 3 vessels. Today the fleet counts 55 vessels. So we have invested across a number of different segments. We have now an EBITDA charter backlog of $3.6 billion, and the average charter tenor is 11.3 years. So we are listed in Oslo. Our market cap is 1.25 billion, roughly, in US dollars. We profile ourselves as a dividend yield company, so we pay quarterly dividends to our shareholders. Excuse me, our shareholders. And based on the last quarter, the dividend yield was 9.6%. And Aker ASA is the majority shareholder, holding about 62% of the shares. Thank you.
And Nicolas, you're with Fearnley Securities.
Yeah, so I'm a partner at Fearnley Securities, and I head up our asset-backed finance products. The firm is traditionally a boutique investment bank within the maritime space. You just heard my colleague Rikard sitting up here in the previous panel. In addition to ECM, DCM, and advisory, we also do we source lease financing for our clients. We've done about a bit over $600 million of lease financing in the last couple of years, primarily sourced from Japan and Western lease providers.
And Elias, you're with Australis Maritime Limited.
Thank you. So Australis is an investment asset management business which is focused on providing debt financing to the shipping and offshore industries. We're looking to build a long-term relationship with ship owners with strong management capabilities. We've set up this platform to be as flexible as possible, so we can go quite deep into the capital structure, up to 70 or 80% LTV. We are agnostic in terms of segments. We can do shipping and offshore, as I mentioned, and that includes some smaller and illiquid segments. We are agnostic from a structure perspective. We can do leases, we can do loans, and also in terms of sizes. We can go as small as $5 million, we can go over $100 million. If you ask us what we believe is the USP of Australis, we would say it's the fact that it's part of Borealis Maritime. We have a dedicated team of credit analysts and ship finance professionals who are, however, sitting together with the rest of our team, commercial, operation, technical managers, which would allow us to obviously assess projects on a bottom-up basis. We have signed our first couple of deals already, and we're looking to grow our portfolio over the next few months.
So it's quite some variety between the panelists and where you come from. But it'd be interesting to hear how, while the ship owners are looking for finance, how do you fund yourselves? How do you get access to money, and what is sort of the cost of funds approach that you have? Again, George, if we start with you at the far end.
Yeah, I think what we do addresses a lot of the things we heard today, and with Nicolas, who were speaking earlier, some of the things that Michael Parker said about banks, the institutions no longer being there for shipping, and Apex Anders Meyerhoff spoke about disruptive and transformative ideas to reach capital. So there is over 10 million accredited investors in the US that have deposits of over $3 trillion. These people, their option is to give the money to a bank and pay the bank to look after their money, or to take their chances on the stock market, neither of which are attractive. YieldStreet, with its warehouse funds seeks and finds asset-backed investments that can provide the kind of yield that is attractive to those people. And our investors come on and buy the funds, the debt or equity that we've underwritten, and get and share in that wealth. So our mission is prosperity for all, to provide equal.
Can I add something to what you're saying? The investor can buy in with $10,000 or $20,000.
Correct.
Which opens the market to a vast potential.
Correct.
We're not looking for an individual investment of millions or hundreds of thousands.
No, our first shipping investment of
George,
$18 million.
just for the benefit of those further behind in the room who may not have heard the question. The question was whether the investors have to pay in millions of dollars, or they can get away with 10 or 12 or 15 or another amount.
Correct. So the investors can put in $10, $20, $30, $50,000, and they can put that into investments. We have now over 90 investments on the platform. So they can have, if they've got $50,000 to spend, they put $10,000 into a shipping deal, $10,000 into a litigation finance deal, $10,000 into a property deal. So they have a diversified portfolio with their whatever capital they have.
Richard, how does RMK go about funding?
We raise equity for ship owners. That's what we do for a living. We've raised, I think, since we set up, about $3 billion of capital. So we know a lot of private equity, family wealth, hedge type companies across the world. And simply we went to a few of our particularly friendly ones and asked for capital from them. So we've raised money that way. That's what funds our platform. Pretty simple.
And Eirik, Ocean Yield has a slightly broader approach, I guess.
Slightly broader approach. I have to say, George is such a nice guy. You know, I'm looking for to buy the shares afterwards. You know. We have basically three main funding sources. It's basically equity, since we are stock listed. Then we have the bank market, and then we tap also into the Scandinavian bond market. We've done equity raises basically 3 times since we started the company. So we've raised a total of 350 million of equity since the beginning of the company. And then, of course, we get very attractive financing from the banks. We basically give the banks 3 feet to stand on. We provide our corporate guarantee. They get an assignment in the long-term charter, and then they also have security in the vessel. So we get very attractive funding from the banking side. And lastly, the Scandinavian bond market, where we typically do 5-year unsecured bond issues. And the last one we did before the summer was priced at a spread of 365. So it's quite attractive cost of funds.
And in terms of tapping the bank market, it means, in a sense, that you become the flight to quality, the sort of preferred customer with access to the bank market, rather than for the ship owners and your customers. Yeah,
definitely. I think being part of a bigger group like the Aker Group, banks are also looking for ancillary business and side business, and where they can make a little bit more money than on the margin. And of course, being part of what we do, where we typically do bond issues, we do cash management and a lot of ancillary business, then that's very attractive to most banks.
Yeah, Nicolas, I won't ask you about how you fund yourself, but Elias.
Sure. So we've used the same model that we used before with Borealis. We've partnered up with 2 major PE firms who have a very long and established experience in shipping. But at the same time, given the overall imperative to lower one's cost of capital if you are to be competitive in this industry, we've also put together a warehousing facility to debt finance part of our capital structure from the beginning.
I think one of the important points of where capital comes from is actually the cost of capital, because that very much affects, obviously, what you can deploy it at and what you need to earn in order to pay and provide a yield back to the investors or whoever is funding you. So it is the right question, where does the money come from? But it's also an important question, how expensive is it when you get it?
Could I respond to that?
George.
If you think about it, the cost of capital, you're saying banks take the money from people and pay them nothing for it. They then lend the money out at LIBOR plus a pittance. They go bankrupt, and then the governments, like the government here, goes to the people to get more money to bail the banks out. So that's not a system. What YieldStreet is saying is whatever we can get from an investment, we will give to the people. So we'll only keep 1.5 or 2%. So if we can get 14% of 200 lawyers in Chicago because they want to fund some litigation, we will take their 14%, we'll give 12% to the people and keep 2%. So what is the cost of capital?
So if I earn 2.5% on my Lloyd's Junior Saver account, you can beat that with your returns.
Correct.
Right. Just checking.
Well, the title of the session is Alternative Finance and Yield, and alternative, I guess, relates to the alternative to bank finance, which we started off with. And we learned during the previous session that the bankers don't look at this as alternative. They look at it as more like, and it's not competing, it's just supplementing the bank finance, we learned. But you're still looking for a return on your capital and on your yield. And what are the goals for that? What are you requiring in order to be willing to open a client relationship with a customer? Richard, how about you?
I think, so our investors need a certain return. I think what I can say is on a portfolio effect. So we got, at this moment in time, we've got 300 million behind us. On a portfolio effect, we need to charge, on average, somewhere between 6 and 6.5 over. And if we get that on average across the portfolio, we can provide very simple vanilla type loan terms, which we think is very attractive to the ship owners. We can keep it, again, simple, which I think is always the easiest way. But that provides the returns that we need to generate for our investors.
And Eirik, if you were paying dividends at a rate of 9 point something?
Well, we're not cheaper than Richard, that's for sure. We typically charge, I would say, between LIBOR plus 4 to 6%. It depends a little bit on the overall structure in the lease, but that's typically what we've done in the project so far.
Mm-hmm. And what LTV is that?
Well, up to 100 if you want.
Elias, would you like to comment?
Sure. Look, I think obviously, as we mentioned earlier, it will depend on the project. But generally speaking, we think about it more in terms of total returns instead of yield, and high single digits works for us.
Mm. And when you advise your clients, Nicolas, is this attractive?
Well, I think you see the cost of capital on this product range from, I think we've gone as low as 4.4 on a 100% LTV basis. It's probably the most competitive lease we've ranged, all the way up to 8.5%, 9%. But I think that on a WACC basis, there are leasing solutions out there that are appropriate and suitable for anyone but the absolute top credits. I also think that the access to debt is certainly diverging, as we've heard. There's a flight to quality, and the funding arbitrage is making an impact. I think one of the problems is that there's still an old prejudice amongst many ship owners that alternative financing, or call it leasing, is sort of a solution for the poor and desperate. I would say that with the extreme evolution of the leasing space and its players over the last 5 years, that's no longer the case. Structures have become extremely creative, and you can fund everything from 60% to 110% LTV. So there's certainly something out there for everyone. But I think unless you have a single-digit equity IRR hurdles and access to debt at less than L plus 200, this universe has a lot to offer, for sure.
Could I answer that question just slightly differently?
Sure.
Investments that our investor base has gotten used to, like litigation finance or property cross lending, sell in under 40 seconds. So we put the investment on the platform, and we tell our investor base that 6 o'clock on Tuesday, this is what the investment, we put all the prospectuses and credit memos, and they read them, and it opens up. Our last one, a few weeks ago, $6.5 million of litigation finance sold in 1 second. So we raised $6.5 million in a second. Now, our first shipping deal we put out at 8%. The ship owner paid 10%. It took us 4 weeks to sell it, our first shipping deal, to 600 people, and as Nicolas said, $10,000, $20,000 each. Our second deal, we lent out at 12%. We gave our investors 10%. It sold out in 18 minutes. So it depends. We track what our investors are asking us and what they want, and then we will price accordingly.
Well, it's kind of interesting to hear you start off describing your various companies. You obviously have quite differing ownership structures and in part sponsor structures. How does that sort of affect the way you do your business? Elias, you have a particularly strong sponsor.
Sponsors, yes.
Sponsors.
We heard it in the previous panel. Obviously, the private equity approach to partnership is a very tight relationship. At the beginning, that takes a bit of time to calibrate, to make sure we're all on the same page of what we're trying to achieve, the investment criteria, et cetera, et cetera. But there's a tremendous amount of benefit that for the life of that fund, it could be 8 years, it could be 10 years, maybe longer, it's the same 4 to 6 people around the table talking about opportunities every single week. And that creates tremendous amount of efficiency in making decisions, both in good markets and in bad markets. So that we would consider to be a significant competitive advantage in the way that we have set up our platforms.
Eirik, you have, with Ocean Yield being listed, you have sort of the typical governance issues.
Yeah, so we do quarterly reporting, of course, on our accounting and all that. And of course, we try and be as transparent as possible. That being said, not always you can disclose all the details in the transaction with the counterparty, but we try and be as open and transparent as we can. And then, of course, we also try and focus on sort of larger transactions that attract appetite from investors and also from the banking market. I think one advantage also being part of a bigger system is that we can move quite quickly, and I think that's also one side of the ownership story that's important not to forget. A couple of years ago, we moved basically within 2 weeks to do a $500 million transaction, even though we didn't have the funds available. When Aker provided then a bridge financing facility, and then we were able to do the deal, turn around in the market, and then raise equity and some more debt afterwards. So that's definitely an advantage for us to be part of a bigger group.
If I can just chip in there, I think that's an extremely important point, and I guess also supports George's platform, that I think anyone who's looking at alternative finance today and wants that higher LTV is doing so for a specific reason, not just to have liquidity sitting in the bank. Well, maybe if you're at the bottom of the market and burning cash, but you want certainty of funds and you want execution risk to be as low as possible. And I think that's where you see the difference between the, call it, alternative financing providers that succeed and the ones that don't, is the ability to execute extremely quickly and have certainty of funds, so you know when you're negotiating with them, if you agree, the deal will go through. I think that's extremely important these days.
Yeah. No execution risk.
Exactly.
Or limited. Yeah. You've described that you're all seemingly quite flexible. You can be anywhere in the capital structure, seemingly. How about your view on the type of assets? Do you focus on specific asset classes? Do you take a portfolio view, or how do you go about creating the total investments? Richard, maybe you have a view on that.
We're agnostic to sector. To the extent we'll look at any mainstream deep sea liquid type of ship, so the tankers, bulkers, containers, gas, etc. We won't do very niche or specialist asset classes such as ferries, for example. And right now we're not going to lend an offshore. But we're specifically looking at portfolio effect of asset classes because that provides balanced risk both to our investors, and then when we're looking at deploying capital and writing loans, those borrowers that we're dealing with can feel comfortable that we know the sectors that we're lending in. We will have lent across all of them. So for us, I think the portfolio balances risk for both on our side and actually for the borrower.
Eirik, you've grown to quite substantial fleet in various sectors.
Yeah, I mean, we started off with basically having main focus on oil service, and then we have moved into more industrial and traditional shipping over time. If you look at our portfolio today, we're invested in 7 different segments, and we think that's very important because, as you know, in shipping, it's a volatile industry. Rates and values will move up and down. When one segment is positive, another one might be negative. So for us, it's sort of creating a balance and creating more stability in our sort of dividend payment capability. Naturally, over the last couple of years, we've sort of also stayed away from offshore. We've had a couple of issues in the portfolio that we have worked through. And now, however, it might be more interesting to start looking at offshore again, as you see that asset prices are low. And there's a lot of optimism in the future of that market. So the point for us is, if you stick to one single segment, you kind of have to continue to do that one single segment throughout the cycle, while you can be more flexible if you have several segments.
Yeah. Well, we've been talking at great length earlier today about scrubbers and 2020. If anyone would like to invest in scrubbers in their vessels, could they find finance from the panelists? Richard.
Oh, great. Yeah, it was a hospital pass, yeah. No, I think scrubbers, obviously we talked about earlier, it's quite an emotive point. There are polarized views on scrubbers. I think in general, even on the big ships, not everybody's subscribing to them. But if we look at it from a pure financing or funding perspective, it's a complicated bit of kit going on to an already complicated bit of kit. And if you're looking for security on that scrubber, it's difficult sometimes to achieve. And I know a lot of the law firms have been working to find the right security package around it. And there are a lot of funds and companies out there that are willing to provide scrubber finance on the basis that they believe there'll be the spread between bunker prices, which will help amortize that cost. All of that makes sense. I think we all know that. We won't lend on scrubbers because I think it is complicated. We'll, from a risk perspective, we'll lend on the assets. Who knows whether it's the right move, and who knows whether it'll be sustainable, and that spread to amortize the cost will actually exist. We continually hear from the oil companies that we work with that they think that delta is going to be much narrower than people think.
Yeah, look, it's fair to say that for everybody on this panel, financing a scrubber on a standalone basis is very, very difficult. But again, we would take the view we are financing a project, and that project would include the vessel and whatever capital expenditure the owner and manager would consider to be necessary for the right commercial and technical deployment. And so on that basis, of course, we would be financing the vessel and the scrubber installation together.
Just to jump in on that again, I mean, I think what we have seen, some of the leases that we've arranged, we've extended the LTV in order to release more capital, and then that ship owner has used that capital to fund scrubbers. The most logical way to do it is what DHT did and was announced this morning, where they extended their loan from their banks, from their corporate lenders, and again, that release of capital allowed them to pay for scrubbers. That, at least in our opinion, is the most efficient way to do it.
Yeah. And you finance the projects and the vessels. During the banking session, we heard quite the focus on the quality of management and the footprint of the company and the relationship. Will the potential clients of yours face the same kind of scrutiny and the same concerns, or do you have more like a project-based approach than sort of a personal relationship approach? Starting with you, George, for instance.
Yeah, thank you. I think that for us is the most important starting point is who the lender is. They are a lender that has been in shipping, that have a good operation. So that would be our starting point. And secondly, the project itself, can the lender make money? Because if he doesn't make money, we don't make money. So the advantage we have is that we can structure it flexibly. We can take part in the earnings. We can do anything that makes sense to the project itself. And the second thing where we have an advantage is that we're quick. So we can look at something, if it makes sense, fund it with our own money, underwrite it, so he gets the money immediately, he or she, and then we can package it and sell it.
Eirik, would you like to comment on the relationship aspect of things?
Yeah, I mean, shipping is a people's business, and it's always, we find it at least important to do business with people that we know and that we trust. We have also found that it's easier to do repeat transactions with people that we have done business with before. It's always based more or less on the same type of documentation, and you've kind of been through the negotiations, previously. So, at least 3 or 4 of the names that we have in the portfolio today, we've done repeat transactions with. So that's helpful. That being said, we won't rule out doing business with also new clients. We've added on a few names already this year. And you can always structure the lease in a way so that you're more asset focused than actually relationship and client focused, which we have also successfully done a couple of times.
Look, to add to this, obviously repeat business is crucial in any sector, and it's also here. And the other thing is when the financing in whichever form has a tenor of 4, 5, 6, 7, 8 years, whatever it is, the likelihood is in cyclical industries, rough patch will be hit at some point, and the closer the relationship that you have with your borrower, the easier the solution will be.
Yeah. Richard?
Yeah, I was just going to say, I think you can mistake alternative lending, which is what this is being grouped at, rightly or wrongly, with an alternative approach to lending. But I disagree with that, and I think it's the same for everybody here. If you cut corners in the way you look at lending capital or writing a loan or a lease, you'll lose money as that lender. So you have to take a disciplined approach, and that's a way not to lose money, which I think some of the other newer entrants into the industry trying to write loans have lost money.
This is a pretty homogeneous panel, all more or less middle-aged men, not quite all, Nicolas, but we're all men, no women. But also when discussing leasing, it's kind of conspicuous that there is no one from Asia here. And I'd like to hear what you think about the competition coming out of Asia. It's noted that the Chinese, in this TradeWinds article, it was noted that the Chinese leasing companies alone accounted for 47 billion worth of leases by the end of 2017. It's quite significant. And also you have active Japanese and some Korean players there. And Nicolas, I'd like to hear with you. You've been working with many projects originating out of Asia. What's sort of your observation?
Well, I think in general, just to take it from very high level, I'd say that the Chinese lessors have had the biggest impact on our industry in recent years out of all these providers. They provided incredible amounts of liquidity, both to owners that needed to free up liquidity on existing assets, but also in funding large new building orders. It remains to be seen, of course, if as they kind of build their portfolios further and maybe at some point reach a level where they don't want to build more, whether anyone will come in and sort of replace their appetite. But so far we haven't seen anyone that's able to match them in scale. Having said that, the Chinese are becoming a bit more strategic in their approach. They like to look at much larger deals than in the past, maybe less commoditized shipping. I think the BOCOM transaction with Trafigura is a very good example. Basically funding a huge order for an end user. The Japanese are always active, but on a far smaller scale. You see the JOLCOs that fund some larger deals, mainly in the liner business for the J3, and recently also for some smaller commodity shipping deals. But the deals that you generally see in Japan are smaller, and it's on the famous one-by-one basis, as the Japanese say. So they're not really providing that much liquidity, but of course you read headlines about people doing Japanese leases at extremely competitive levels, which always gives them maybe an undeserved amount of attention. The Koreans, we haven't seen they haven't been very visible in the last few years. I think that what you've seen out of Korea has been a lot of activity from the, call it ECA type banks that are supporting funding new building orders. But to sum it up, China is the most important player out there, but things are also changing there.
Rolf, may I comment on that?
Please.
The Chinese banks are the Chinese government, and they're funding their shipyards. So they're funding Chinese business. I think it would be wrong for European banks to try and compete with the Chinese government. So on price. So I think I was in Asia last week. I spent a week there. There's a lot of business going on. The Chinese credit there's lots of money out there. It'd be better to partner with them if you can, and use their cheap money to lower your cost of money, and do some deals with them. Mm-hmm. And so, yeah, that's why I was there. So I think it's a better tactic.
I want to add one very quick point to that. I was also in Asia last week, and I had a very interesting conversation with an Asian banker working for a European bank. And he told me about a deal where a Chinese leasing company was going to the Japanese JOLCO market to fund themselves, so they could then provide a lease to a Western ship owner who was again providing a time charter to an oil major. And I think, yes, in theory, you can probably financially engineer that in a way that looks like it makes sense, but also remember that there's a lot of leakage of lawyer fees and broker fees through that structure.
Well, that's not only bad, you have to remember that. But I know from the organizer that we're very tight on time here. I thought it was interesting that on the Bulker panel earlier on, one of the panelists suggested that owners tend to repeat old mistakes by over-ordering at a time when they should show discipline. But it was also suggested that maybe the leasing companies were sort of pushing them ahead to place the orders. And there's a very good old maritime saying that smooth seas do not make a good sailor. It sort of suggests that experience teaches you something. but that will be for the next panel or maybe next year to see whether anyone has learned. So thanks to the panelists.